Okay, so next is loan purpose. We know what is loan purpose.
For the what purpose the borrower is taking the loan from the bank?
Okay.
Some kind of purchase or refinance.
Purchase, refinance,
Finance,
construction, and construction to permanent, right?
Yeah, right, sir.
And there could be other as well, but we will focus only on these, right? So what is purchase? To purchase means purchasing a new home, right? Very simple. In the refinance, you're taking a loan on an existing property, right?
Right, sir.
Right, the property which I already own, I can take a loan on that. Right. So refinance, like let's say this is our property. Okay. And there is a loan going on with Citibank. Done?
Done, sir.
That loan is going for 100,000. That is my current balance I need to pay. Now I wanted to take another loan. My property value is $300. The outstanding balance is only $100. Now I need some money. Maybe I need 50,000 for my children education, or there could be like maybe some other bank is telling me that okay, you are paying 6% interest rate. We have offer for you to pay the 3% interest rate, right? Now I will be happy that okay, 6% instead of paying 6%, why to pay 6%? I can pay 3% of the interest rate, right?
Right, sir.
What will happen in the 6% interest rate? I am paying $1,500 per month. In the 3%, I might be paying only $800 per month. The only twist is if I'm going to purchase a new, I'm going to refinance a loan, I'm going to take another loan on this property. That means I have to pay the closing cost. Closing cost could be $6,000. Right? I'm going to pay $6,000 closing cost on this new transaction if I'm going to refinance. But I'm going to, how much I'm saving per month? 1,500 to 800 means 700 per month I'm saving, right? This is what my savings. So in 10 months, I can save $7,000. So within a year, I'm going to recover my closing cost. Whatever the cost I'm paying to refinance my property, I can recover it within a year. And after that, whatever I'm going to save $700 per month, that is my saving, right? So is that beneficial for me or not?
Yeah, this is beneficial for us.
Right. So whenever we are going to refinance as an underwriter, we are going to we are going to approve any loan for a refinance. We always need to see the benefits, profits for our borrower. It is not that we are just going to, somebody is coming to us, so we will give them a loan. No. Right? As an underwriter, we are always going to see, is there any benefits? Is there any profit, right? For the borrower who is going to refinance. If somebody is just saving $100 per month, it will take how many months? 60 months, 5 years to recover the closing payment. Is that wise? No, right?
No, sir.
That is not a profit. So that is how we always, whenever somebody is gonna come for a refinance as an underwriter, we always need to see what is the benefit of refinancing this property. Why we should ask borrower to refi? How I can approve this loan, right? That if there is a benefit for borrower, the refinancing this loan, right? So in the refinancing, this is something as an underwriter we always need to take care. There could be like somebody, sometimes you will see someone is refinancing property from 6% to 3%, right? But their mortgage payment is increasing. How is that possible? Somebody already paying 6% for 30 years. Now they are getting 3% interest rate, but they are reducing their term for 20 years, right? They are paying $1,500 per month. Now they might be paying $1,800 per month. Now if you are going to look at only at the payment, it is the $300 that borrower will be paying extra, additional.
Yes.
But then you could see, okay, but borrower will be closing this loan 10 years before. So that is also a benefit, right?
Right, sir.
So that is how we are going to look at every refinance. We are going to look at the benefits for the borrower. What is the benefit for the borrower? It is not that we are just going to calculate and DTI is 40% or 45% and we are going to approve the loan. No, all these aspects need to be considered, need to be properly reviewed. Then only we are going to approve the loan. So whenever we are refinancing, we need to see what is the benefit for the borrower. If somebody is getting $50,000 in hand, obviously that is a benefit, right? It's a cash outflow. But wherever borrower is going for no cash out, their borrower is not getting any cash. They are just refinancing their home for the lower interest rate, lower term. Then we always need to look for the benefits. What are the benefits for the borrower by going for this loan? Is that clear?
Yes, sir.
Very good. Okay. So this is how we are going to check. Now the second thing, why we call it refinance? We call it refinance because we are financing it again. Previously we had finance, like I told you, Citibank. There is a loan going with the Citibank for $100,000. Now I want to refinance this, again finance this loan, right? That is why we used to call it refinance. So first what we need to do, whenever we are going, let's say we are going to take a loan from US Bank, okay, and there could be different benefit. Might be we are getting 3% interest rate as we discussed previously from 6%. So what we need to do, borrower wanted $50,000 in hand. It's a cash for any different purpose. They want to improve their home. They wanted to pay for their children's education, anything. So that is why they need $50,000 as a cash. Now they are going to US Bank and they are taking this loan. Maybe at 3%, previously it was at 4%, or even previously it was 3.5% something. But the main purpose is to get $50,000. So now borrower has two options. They can go to US Bank and apply the second mortgage. Remember we discussed second mortgage in the last session. CLTV, LTVs, what is the LTV and what is the CLTV? When we were discussing the FHA mortgage, that time we discussed these things, right? I also told you whenever somebody going for the second mortgage, it will always be on a higher interest rate, right? Plus less tenure. It could be 10 years, 15 years loan, 5 years loan as well, right? It's a second mortgage, high interest rate. Why high interest rate? Because what is going to happen if tomorrow property will be foreclosed, remember, then who will get the first priority to recover their money? The first mortgage. Yes. That is why the second mortgage is always going to be on the higher interest rate. More risk, more benefit, right? More profit, right? So second mortgage. Again, the second thing, borrower is already paying $1,500 for the first mortgage, and now he might need to pay $800 for the second mortgage. The total payment will become $2,300 per month that need to be paid. Now two loans are going on that property. Right? Now, instead of paying two mortgage payment per month and higher payment $2,300, they might go to the US Bank and they can say they want to, instead of taking the second loan, they wanted to refinance the first mortgage. What do we mean by that first mortgage? Means they want to close this loan and they want to take another loan as a first mortgage. How that is going to happen? So now US Bank is going to give them 150,000 loan amount. Why 150,000? Because 50,000 that will be paid to borrower right, as a cash, and 100,000 need to be paid to the Citibank. So that will be paid off. Now borrower has again only one loan, that is first mortgage, right? Going with US bank and paying the payment only. And because it's a first mortgage for 30 years, 25 years, right? And it will again be at the less interest rate comparing to these two loans. So that is why the first mortgage is going to be beneficial for them instead of going for two loans. Does that make sense?
Yes, sir.
Right. No, so that is how it is called refinance. The another question is here for you guys. In this example, I told there was an existing mortgage. So paying off the existing mortgage and taking the new loan from a different bank or from the same bank is going to be refinance, right? But if property doesn't have any mortgage payment, no loan going on, mortgage payment or mortgage balance $0. There is no loan exist on the property. This property is called free and clear. If anyone is going to take a loan on this property on a free and clear, right? If this property is free and clear from all the mortgage, no loan going on this property. If somebody is going to apply or somebody wanted to apply a loan on this property, whether that will be a purchase or refinance,